We could be in 97, or we could be like February 99 and 1 month away. And that's really going to me, I think if you start seeing some hard data come in that is significantly weakening. I'm not just talking about, a jobs number that's a little weaker than expected. I'm talking, multiple quarters of some real downturns in the economy. That I think would probably do it. And we all lived through the fiber optic build out of the late 90s, right? Yeah. And, every single one of these companies, and they were great companies at the time, they overbuilt and they went bust. I'm not saying Meta goes bust. I'm not saying any of these big companies go bust, but we've seen this story before. No matter what the company is, no matter what the new tech is, it always gets overbuilt. It always goes too far, and eventually it starts to come down.
Welcome to the Risk Reversal Podcast. I am Dan Nathan. I'm joined by Guy Christopher Adami. Guy, there he is. Okay, we say this often, and this is not to be, glib or whatever you want. This is a very special edition of the Risk Reversal Podcast. If you are watching this on the YouTube, you see a face that you probably remember from CNBC's Fast Money. He has not graced us with his presence there, and I want to say a couple of years, but this is Brian Kelly. He is what Guy would call, what did you call him? You coined this years ago. This name.
He's a Bitcoin baller.
He is the Bitcoin
baller. He's all of those things.
All right, so let's welcome Brian Kelly back to the radio show.
Yeah, thanks. First time caller, long time listener. Thanks for having me on.
Let me opine, or let me just sort of chime in quickly. I think I met Brian in the early, somewhere between 2010 and 11. Is that probably about right?
The mid-aughts, as you might say.
Mid-aughts. I don't know what that means.
By the way, that's not the mid-aughts.
Oh, it's not?
That's like the end of the aughts.
Oh.
The aughts were the 2000s.
The
Mid-aughts would have been 05, 06.
Right.
Okay, sorry.
Right.
So you met him 2009,
mid-decade.
10. That's
Okay, let's just so let's say better part of 16 or so years ago.
Yeah.
And there are very few people that I immediately am drawn to. Brian Kelly was and continues to be one of those people for a myriad of different reasons. Your intelligence, your sense of humor, self-deprecating, entrepreneurial spirit, willingness to take risk, flamboyancy, which is a word that I don't use often. All of those things put together was the reason why I said to myself, I really like this Brian Kelly
You
character.
said self? All right, but
that's very kind.
One last thing, though, Guy, that you left.
It's true.
That
Whether
you
it's
left
kind
out.
or not is irrelevant.
That you left out speaker in the third person.
Wow.
Well,
that's all G Swizz. I mean, I've always spoken to third person, but he asked me a question one night. He said, what does BK think? And I said, I'll tell you what BK thinks.
I love it.
And we were off to the races from there.
It never ended.
Yeah.
All right, let's just get through some of the other, kind of superlatives, if you will, about BK.
Sure.
You wrote a book called The Bitcoin Big Bang. I remember you were writing it in 2013.
Mm-hmm.
It published in 2014. You have some of the most brilliant people that are kind of gave some quotes on the inside or the back cover of that.
Some of the most brilliant that I know.
And
Dan Nathan being one.
Correct.
At the top.
So just to be clear, it's called The Bitcoin Big Bang. And you wrote that. I mean, literally, most people who were watching Fast Money at the time had no idea what Bitcoin was. Most notably, Guy Adami probably was one of them. I went to the book launch party in 2014. I think it was at DCG headquarters. I've often used the expression, it was like the cantina scene in Star Wars. Melissa Lee was there too, which was really fun. I know that she was really interested in it back then. Sorry. All right, we're going to talk crypto. We're going to talk macro because that was always one of the things that you did on the show, differentiated yourself. So we're going to talk about the current environment. A lot of our listeners who know you haven't heard your opinions on that sort of stuff. And we're going to talk about just where we are in this kind of crypto thing. It's really changed a lot, with the treasury strategies and stable coins and all that sort of stuff. So we're going to do all that. One last thing on the Bitcoin Big Bang. If you go to the podcast store, whether it be the Spotify or the Apple, leave a review for the Risk Reversal podcast, okay? Take a screenshot, send it to contact@Risk Reversal. We are going to send you a copy of the Bitcoin Big Bang.
If we can find it.
We
can, if it's still, probably sold out of the Barnes and Nobles and all these different
exactly.
places.
Well,
Yeah.
we're going to get it from the Amazon. All right.
Well,
so
okay.
let's start on the macro before we get to the crypto
Sure.
stuff
Yeah,
here.
let's
Okay,
do it.
so let's set the stage here. It is Thursday, July 31st. We had a Fed meeting yesterday.
Mm-hmm.
We have trade and tariffs things going on. We have a lot of data tomorrow morning. By the time you're listening to this, we will have the all-important July jobs report. We have a market that has grown out of multiple expansion in a meaningful way this year. What are some of the things that you are most focused on the macro right now? Because there's a lot of balls in the air.
Yeah, listen, I mean, if you talk stock market in general, earnings have been decent. So that is kind of what's going right and what's going well. And that probably drives the market for a while here. You know, my view is we're in this kind of, I don't know if it's the end stage, but it's certainly the mom and pop stage. You know, you get a lot of these meme stocks running, those type of things. Those don't happen at bottoms. Those happen closer to the top. I'm not saying we're at a top, but if I have to look out 6 to 12 months and say, what am I worried about or what am I concerned at? I'm looking at currency and rates. You've had most global rates for the last 2 years basically trade in a straight line, just sideways, right? You're starting to see some cracks in Japan bond market potentially. But then look at currencies and most specifically look at the RMB, the Chinese yuan. That is going to be the epicenter. If we're going to have another shock in this market, that's where it's going to come from in my view. And you're starting to see it slightly weaken over the last few days. It's been strong for the last year or so. So this change has got my attention. Let's put it that way.
That's why I've always loved BK, because it's almost as if he's in my head like some alien being reading my every thought, which, by the way, there may be some truth to that.
We've talked about that
figure
extensively.
it out entirely. Yeah. But you're right to bring up Japan and you're right to bring up China. In terms of Japan, real quick, and you start to connect dots, and a lot of times people say, we're not really worried about the Japanese market. Why should we be? And there are reasons to be. If you remember, I know you do, it was last August when that whole yen carry trade sort of unwound before our eyes, and it obviously had huge ramifications. Now you have JGBs, you have 10-year yields in Japan, probably the highest they've been in 13 or 14 years. 30-year, 40-year rates in Japan are at all-time highs against a backdrop of a currency that continues to weaken to the tune of where we currently are now, north of 150, with bad demographics. There are just a lot of things to be concerned about. And then you say, well, how's it going to impact us? Well, they're still one of the largest, if not the largest owner of our treasuries, and something has to give. So I think you're right to point that out, but sort of connect some dots in a way much better than I just did.
Well, I don't know if I can do it better, but I can add on to what you say. And it's more than just treasuries too. I mean, if you recall, most of the Japanese banks, and particularly the smaller institutions, the smaller savings banks over there, have invested in corporate bonds here in the US. They couldn't get the yield in Japan. So the money flowing from Japan and back from China has been the hallmark of this bull market for the last 20 years. And so you have to be concerned if that starts to reverse. That's why the yen carry trade, nobody knows what it is until it blows up and then we all talk about it. But at least you have to know that all these banks in Japan have bought US securities, whether they be stocks, but more importantly, corporate bonds. And that has supported the market. So you look at spreads and all of that, and you say, why aren't they blowing out? Why aren't they doing this? The economy's doing that. It's just because there's been this steady drumbeat of capital. Now, if that capital has to come back to Japan and back to China, all those flows reverse, and that is going to mean fewer buyers for U.S. equities, U.S. assets, that type of thing. So that's why, if I'm looking for a shock, that's where I think it would originate from.
All right, so let's talk about that sort of sell America in air quotes a little bit that we saw in April, right? So we saw the dollar, kind of got pummeled in April. I think it was like mid 105, 106. I think it made it high, over there at 110. That's the Dixie. Well, I want to say 6-7 months ago or so. It got as low as 98. It's recently bounced from 98 to about 100 here. We also saw the 10-year yield. What did it go up to? 4.78 or something like that. That kind of freaked out the administration. So let's talk about how the trade war, and again, we're a day we're recording this, before we're supposed to have this, deadline for deals. It doesn't look like we're going to have Canada, Mexico. We're not going to have a lot of clarity as it relates to China, but they have another 2 weeks or something like that. How does the trade situation, how does the tariff situation kind of work its way into what you just described here? Japan was kind of quick to make a deal. They're 4% of our imports, right? It's not that important. We have an EU framework that's 20% of our imports. So how does the potential for a protracted trade war work into that whole kind of psyche as it relates to currencies?
I mean, I wouldn't weight the trade war as very high relative to the bond market, right? And here's why I say that is because, at where's the 10-year, the Japanese 10-year? I think it's at 1.5% now or something which is the highest it's been in 10 years, right? So we've got this run up in yields. At some point, that becomes a problem for the Japanese economy. And so what's the solution? What does Japan do to that? They haven't really been able to generate GDP growth, right? They had a period of deflation. They're back to inflation now, but they don't really have the demographics to generate the type of GDP growth they need to get out of their debt pile, which is something north of 400%.
Isn't that the same for China, though?
It is. That's why I say both of them are important, right? So what do you do to that? How do you keep, if those 10-year yields, let's say they spike to 2% or 3%, there's going to be some magic number, right? That they spike up there. Then that starts to impede their corporate market. And so now the Bank of Japan has to do something. What they can go out there and buy Japanese bonds, or they can force their companies to repatriate US dollars into Japanese yen and start buying in the Japanese market. So to me, that would be the bigger flow, as opposed to, and that would make the yen rip higher, dollar fall, and all the flows would come back. So to me, again, I'm talking about what is the big shock out there. That's the one that I worry about, is all those flows repatriating back to Japan and to China, for that matter, repatriating back to China. And again, you'd have fewer buyers for US Treasuries, fewer buyers for Microsoft bonds, all of those things.
And those are extraordinarily valid concerns, and concerns that I've had for a while. And by the way, the concerns that sort of bubbled their way to the surface a couple different times over the last couple of years, only to sort of be squashed down by whatever forces are out there. But it doesn't mean they've gone away. And in some cases, they've gotten a little bit worse. And, I've been trying to figure out, to your point, what is the level where things start to go a little pear-shaped? And, what is this overall weakness in the dollar trying to tell you? And, why does the equity market continue to do what it's doing? And those are the things that are sort of, they don't keep me up at night, but that's what I spend the majority of my time thinking. But, let's continue to sort of play this out. There's obviously an administration here that wants the Fed to lower rates. And something that I've said, and I know something that you probably believe and know to be true, the Fed controls what they can control, but they don't control the bond market in any way, shape, or form. And I think, in my opinion, BK, big mistake if they sort of acquiesce, because I think the bond market's going to challenge them. Thoughts on that?
Well, it has already, right? Every time that there's even been some thought or even cutting rates, right? The 10-year yield goes higher because people are worried about the inflationary impact. So I think that's, you have to extrapolate that and say probably happens again. And again, if you start to lower rates here, that again makes, other countries maybe relatively more attractive on the short end. So maybe you take a few buyers out on that sense. I think we can argue about a quarter point or a half a point. I don't think it's going to matter. I would say the one, again, if we're talking about what do I worry about? You lower rates, and let's just say the 10-year goes down with it, but let's go from 5 years down lower, all rates start to go lower. That's also an income stream for U.S. investors and U.S. savers and retirees. And these are the folks that have been kind of, they're fantastic. They have their bank account and they get 4.5%. They don't have to do anything, and they keep buying all this stuff. So, you start cutting rates, you're going to start cutting an income stream. So it might be somewhat counterintuitive that, hey, we want rates at 1%. Well, just remember, you're taking money out of people's pockets when you do that as well. So you might actually get a weaker economy with lower rates, which would really confuse everybody.
Right. And part of that thought process, I've seen some stuff written about that. It's not, there's some older savers, right, who maybe have less risk as it relates to the stock market. Maybe they've scaled down their homes, or they don't have a 3% mortgage or that sort of thing. So if you start taking away that sort of savings rate for them, that's kind of a problem. Now, the flip side of that is that you have younger folks who, let's say, they own homes and they borrowed at very low interest rates. They've been exposed to the stock market, and the wealth effect there has been really impressive. So I want to kind of tie that together with something that you just said is like earnings have been okay. Now, we've made the case all week, or at least over the last 2 weeks since we've been getting Q2 earnings, there's been a huge bifurcation, right? So as we're talking about this right now, Microsoft is just top $4 trillion in market cap. They put up the sort of quarter that I think folks will remember for a very long time. It was an inflection point. Whether you agree that it deserves to trade at the multiple it is, whether you agree that on the other side of this is going to be some leaner periods, right? Because they've just been spending like drunken sailors. They're getting the return right now on a relative basis. That looks very attractive, right? And we're seeing that at a Meta. So my question, I guess, more has to do with the fact that you just said earnings are good, but really we're seeing some real stress, whether it's be in retail, whether it's in consumer discretionary, whether it's autos, whether it's these companies that are really being affected by tariffs that while we have lesser than threatened sort of tariffs, there's still material input, surges that are going on that are going to hurt margins and the like here. So we see a bifurcated sort of earnings picture right now, but you just said you could see this going on for longer, right? And so you think about the wealth effect that's being created. Is it really that opportune time to say, well, this could be 1997 in that 5-year period where we saw 5 consecutive years of 25% returns? I know that was
could be,
a lot.
But it also could not be, and that's the problem. Like, I don't know, right? We could be in 97, or we could be like February 99 and 1 month away. And that's really going to me, I think if you start seeing some hard data come in that is significantly weakening, I'm not just talking about, a jobs number that's a little weaker than expected. I'm talking, multiple quarters of some real downturns in the economy that I think would probably do it. And we all lived through the fiber optic build out of the late 90s, right? Yeah. And, every single one of these companies, and they were great companies at the time, they overbuilt and they went bust. I'm not saying Meta goes bust. I'm not saying any of these big companies go bust, but we've seen this story before. No matter what the company is, no matter what the new tech is, it always gets overbuilt. It always goes too far, and eventually it starts to come down. We're not at the first inning of it, and we're not at the 9th inning. Maybe I'm stretching out. Maybe it's the 7th inning stretch. I'm not sure, but we're somewhere there. We're not in the beginning of this whole thing.
I believe that was Taft, by the way, if I'm not mistaken, rather large man that stood up in the 7th inning. Fans saw him do that and acted in kind, and that became the 7th inning stretch.
See,
I'm going to say a word, BK, and typically a word is not a question, but I know that you're inside my head, and here is the word, and you can respond in any way, shape, or form. Gold.
I mean, I'm a Bitcoin guy, but I also like some gold. I think you can buy it. I think you can buy it primarily because you can make an economic argument that perhaps if the dollar gets stronger, gold goes lower, you get some sort of correction, blah, blah, blah. Maybe lower yields help it go higher. But I think probably the more important thing, which I think you've been talking about quite a bit, is the non-economic buyers that we have out there, which is the central banks, right? They don't care what the macro is doing. They're just saying, I need more of this gold to protect my particular currency, economy, to have strength in the world, that type of thing. So I think there's probably a bid in the market someplace. I'd be a better buyer of it on a sell-off than I would, certainly would not want to short gold here.
Torsten Slok of Apollo, I think he had a note out this morning, or he has a daily kind of chart. And it's actually really good. For any of you guys there, we'll put it in the show notes. You just subscribe. It's like a chart and a few comments, and it's really kind of topical. I think I sent it to you guys this morning, but he was talking about how Chinese citizens have been buying gold. And I know we've been talking about for a few years now, guys highlighted the fact that the Chinese central bank has been buying a lot of gold at clips that they haven't done in a very long time. All right, let's switch gears here a little bit. Let's talk about nerd gold here. Okay, so this goes back to the Bitcoin Big Bang. You were writing about it in 2013. So I want to start this conversation with what interested you about it back then, and the pillars of the bull case have changed a lot over the years, right? So we had this kind of retail frenzy into the highs in 2017. Then we had this kind of, what would you call it? A wasteland, or what was it? For a few years, it wasn't really picking up its kind of head again until we got into like COVID-y times, that sort of thing. Saw a big bubble there. It was ICOs in 17. It was NFTs and all this other stuff, Web3 and DeFi and all that stuff into the highs in 21. Then we saw another sort of period where you couldn't give the stuff away for a while.
Yep.
And here we are again. How are the pillars of the bull case changed? Let's just focus on Bitcoin and then we'll broaden it out a little bit.
Yeah, I think if there is a difference, I mean, again, my view continues to be, has always been, we are still in the speculative phase here. So you're still going to get these speculative moves based on some sort of narrative. You know, probably the biggest narrative that's happening now, you guys have talked about, is treasury companies, right? That's probably the big driver right now. But what has changed in the last, what have I been doing this now, more than 12, 13 years in Bitcoin, is the nature of the buyer. You have real institutions, you have macro players, you have traditional value players buying it. So I think what's going to happen, and this has always been my view, is that, you know, back in 17, the story was, well, it's uncorrelated to every other asset out there. Well, we found out that that's not always true. And I think it becomes more correlated to the financial markets as it gets more integrated. And so that, if you follow that logic along, that may mean that the so-called 4-year cycle that we've had around the halvenings is going to be less pronounced.
Just explain that for a second, okay? Because I know what that is, but maybe so the 4-year cycles around the halvenings every how much?
So every 4 years, the daily supply of Bitcoin is cut in half. It used to be a significant amount; it's a small amount now. But if you think about it, like in the terms of oil drilling, right? It would mean that every 4 years, half the oil rigs are taken out, right? And that's the daily supply. It doesn't mean that the supply of Bitcoin goes in half. It just means every day the amount that's pumped out gets cut in half and cut in half.
Creating more scarcity, basically.
Well, creating more daily scarcity, right? And I think that's an important point because it's not as if Bitcoin's taken off the market, right? But now you're talking about such a tiny fraction of the actual market that I think that's this cycle. And what used to happen is you'd have a bull market leading up to what they call the halvening, that cut in half. And then it would usually last a year or two after that. And then you'd have your crypto winter and your bear market.
Crypto winter.
Yeah,
yes.
crypto winter. Yeah. I think that is probably going to be less significant. Those cycles will be dampened at the very least, and it'll probably be taken over more by macro factors.
All right. Do you think it's less consumer driven? Because you use this expression, and I think Guy will remember this. You kept on saying that one of the pillars, and this is kind of, I want to say, despite all the goofiness that was going on in 2020 and 2021, you were saying that the real story is the wall of institutional money that is coming at this asset class. And you ended up being very correct, because that has to be one of the biggest drivers, and obviously regulation a little bit.
Yeah, no, and I think that's exactly what I'm talking about. It took a little longer than I thought it was going to, because I've been talking about that since 2017. But I think that's the point, is that the institutional investor is here. In 2017, when we had that huge bull market, and frankly, even in 2020, 2021, you didn't have a lot of institutional buyers. It was still difficult and hairy and career risk to buy Bitcoin, right? You didn't want to do it. And so you just didn't have those investors. Now, with the invention of the ETFs, with the regulatory clarity, which is huge right now, and we can talk a little bit about the Genius Act, because I think it is more than just stable coins. But all of those things have now contributed to say, hey, instead of like, I don't want to touch this, every institution's having a conversation is, how does this fit into our portfolio? How do we buy it? So that's money's here, right? And, you know,
but why do the institutions, why do they want to buy it? That's what I want to know. Like,
I mean, well, I think...
Because you said we're still in the speculative phase.
Sure.
Do institutions invest in speculative assets like that?
They all do.
Do they?
Yeah, that's what they do every day.
Okay.
Bonds, stocks, those
so
things.
are they thinking about it in like alternatives bucket, like as far as
I think
VC?
So I mean, it's gone from the VC bucket to a more alternative hedge fundy bucket type of thing.
But it's not in the gold bucket.
I think So that's a great point. It should be in the gold bucket, in my opinion. But if you look at correlations, it's in the stock bucket, right? That's what it's correlated with. You're about, on the last 30 days, on a rolling correlation, it's like 65% correlated with the NASDAQ.
Okay, so, but it's a $2.5 trillion market cap.
Yeah.
Okay, so right now we have two $4 trillion market cap companies. We probably have 3 or 4, $2 trillion market cap companies. Why is it so interesting then? Like NVIDIA's outperformed it in the last 5 years, and it's very correlated to NVIDIA.
Yeah. Well, I mean, if you're buying it because it's going to be a $25 trillion asset.
Okay,
not a
that's
$2
what
trillion
Joe Lubin
asset.
said to us, Guy, last night on Fast Money. We were talking about, now I had to do some quick math, and I'm not so good with math, but I was like,
We're working on it with you,
it's
though.
$2.5 trillion. And he said, well, if Bitcoin's going to be 20 trillion, then Ethereum could be X and such.
Yeah. And so here's
You think that's a realistic sort of?
Sure, sure. But and it sounds crazy when you compare it to a Microsoft or an Nvidia. But here's the thing that's the difference between currencies and stocks. Currencies have to grow to the size they need to grow to service their underlying economy. So real simple example. If I want to buy a $10 sandwich from you, I need to have at least $10 in currency to do that, right? We probably need to have 20 because you need to have some money sloshing around. So if Bitcoin is going to be, let's just even say it's a substitute for gold. Guy probably knows this off the top of his head.
But gold's not a currency, and you guys have been telling us for 10 years that Bitcoin's not a currency. You have to think about it differently.
I don't know if I've said that.
Really? A lot of these folks did not want it to be called cryptocurrency.
Oh, maybe they did.
Really? You don't know?
I don't know. I'm sure people did.
Yeah, okay.
I'm sorry. I wouldn't lump me in.
But you're not buying
guys.
a $10 sandwich with cryptocurrency. You're not buying it with Bitcoin.
But let's just say all you do is use it for gold as a substitute for gold. That's one use case among many others.
Yeah.
But let's just say that seems to be, to me, has always been my base case. Like, let's just say this is a competitor to gold and it takes over gold. I think the market cap of gold right now is somewhere around 15 trillion, right?
Maybe a little higher, but
maybe a little higher, right? Okay. Well, and Bitcoin's at what, 2.5 trillion, you said, right? Something like that. Okay, 2.5 trillion to 15, that's a 7x, right? So that's not bad. That could happen. I don't think that, I'm not saying something crazy if it just took all the market share from gold. That's not crazy.
Yeah, but you still haven't told me why you want to own this asset class. Just speculation? Like what?
Well, yeah, that's every asset class. But okay, so why do you want to own it? You want to own it.
Well, you want to own Nvidia because you think they own a market and because of cash flows and because they basically created a product that's going to revolutionize the world.
Yeah, well, that's what Bitcoin did.
Okay.
Yeah, I mean, Bitcoin is, as I've said it. I said it in my book. I've been saying it for 13 years. I think it is the most important innovation in the last 600 years of financial history.
Whoa.
It is the equivalent of the Medicis the Medicis starting. What's that?
Italian family.
Yeah, exactly. Nice folk. But the Medicis started using double entry accounting, right? That's what they pioneered. And they developed basically our modern financial system is double entry accounting with a bunch of big institutions on either side. Bitcoin comes along and just automates that all. So when I look at any other industry out there that got disrupted by software, which is all that Bitcoin is, if I look at what happened to the post office when email came around, what happened to media when the YouTube came around, what happened to radio programs when the podcasts came around, right? They all got completely disrupted. And that's what you're speculating on, is that Bitcoin is going to disrupt the financial inner workings as we know it. And the currency, the technology behind Bitcoin and the currency behind Bitcoin will be used as this new improved financial plumbing. Okay.
Almost to the day, 5 years ago, Michael Saylor at MicroStrategy invested what is now a quaint $250 million to diversify the balance sheet from dollars to Bitcoin. In your opinion, how important, this is not a two-part question, but was it inevitable that somebody was going to do it, or was he this visionary that sort of opened the door, and how important was that?
So he certainly opened the door because nobody else was doing it. He certainly pioneered the way to create a Bitcoin treasury company. The bet that he's essentially making is he's short bonds, short dollar, long Bitcoin, and short a stock, right? That's ultimately the bet that he's making. He's selling everybody stock and he's buying Bitcoin. So for me, I'd just rather buy the same thing he's buying. So why not just buy Bitcoin? As long as he can continue to sell stock to buy Bitcoin, that game works.
Now, what he will say correctly, and you know this, that since somewhere between the end of World War I and the beginning of World War II, the United States dollar has lost 95% of its value, a trajectory that does not seem to be stopping anytime soon. And he will correctly point out that if you're holding dollars, you're basically holding a declining asset. And I think more and more people, more and more corporations, institutions are starting to come around to that way of thinking. But Next question is, who's next? Like, who's next to sort of cross that threshold? Because it definitely requires a bit of a leap of faith.
Yeah, it requires a leap of faith and a supportive board. I've talked to Fortune 500 companies since 2016, 2017, behind the scenes talking to them about Bitcoin. They'll ask me, hey, what do you think about this? And it always comes down to my board won't let me do it. It's an optics, it's a PR, it's that type of thing. So if there's anything that Saylor has done, he's made it a lot easier for people to do that, particularly with his stock price going up, right? Everybody at the board goes, okay, how do we want to get our stock price up? Maybe we buy a little bit of Bitcoin. Now, why would a company want to buy Bitcoin? It's the same reason they want to put corporate bonds on their balance sheet, for exactly what you said. If you hold any fiat currency, that's the entire point of the fiat currency. It's inflated away every single year. That's what the central banks do. That's nothing new. So people used to buy stocks and corporate bonds, and they would buy gold. And now you have the option to buy Bitcoin too.
And Guy has had a couple of really great conversations with Michael Saylor about that. And I think it's interesting because he's had a little bit of a back and forth with Jim Chanos, friend of the pod and a good friend of ours. And Jim has basically said exactly what you said. He's like, I want to do what Saylor's doing. I want to sell MicroStrategy or strategy and buy Bitcoin. Like, that's the trade that Saylor's doing, right? And so, which is interesting because I think that that Michael Saylor thinks that they're far apart. He thinks he's making a short call on MicroStrategy. He's actually putting in place the same exact trade and benefiting a little bit from the leverage that Michael Saylor's trying to create. Isn't that fair or no?
Yeah, I mean, I personally would not want to be short strategy at all. I wouldn't want to be short any of that because you get game stopped, right? I mean, everybody's buying strategy because of the spread and the NAV of the Bitcoin and all this stuff, and it's all, retail or whatever. And next thing you know, if you're short it, that thing could rip to infinity and Bitcoin only goes up 20%. You're never going to make that differential back. So to me, the better trade is
but that doesn't support Michael Saylor's reason for doing it. He's basically using his stock as currency to buy the Bitcoin because he thinks that Bitcoin should go up, exponentially relative to MicroStrategy.
Yeah,
that's the only reason why he'd be doing that.
And it's reflexive, right? As long as he can sell enough stock to make that happen.
But sooner or later, he just can't anymore because
the moment he can't sell stock, the moment he does an at the market issuance and it fails, you want to sell Bitcoin as fast as you can.
Right. Okay, that's interesting.
For today, right? It may change in a year, but
come
for
back
today.
And tell us when that moment is?
Yeah, well, you'll know it. You'll see it on the tape.
So let's talk stablecoins right now, because outside of what the Treasury trade is, stablecoin seems to be the thing that's drawing a lot of excitement in and around the space. Explain it to us what it is right now relative to when we had some real issues with stablecoins going back, let's say, 4 years ago.
I think that's the best way. Okay. So real simple, what a stablecoin is I put $10 in a bank, I issue a cryptocurrency against it, and you can use it as a dollar.
Okay, so why would one do that? Because in a well-banked, economy like we have here, why would one do that?
One would do that because the fees are lower. You can send it for free, right? It's no different than Zelle or PayPal and having your money in there. You can zip it around to people.
Which, by the way, Zelle is free.
Yeah.
Okay, so we're well-banked here. We have Zelle. So why would somebody like me use a stable coin if they're both free and fast?
It's another option. I mean, I think stable coins are important to the ecosystem.
Okay,
fine.
so my dollar doesn't have the complexity of being backed by something other than the faith of the U.S. Treasury.
Yeah, we have an electronic dollar. That's what we have today. Correct. I can send it anywhere. So
why would the U.S. Treasury create a stable coin when we have a U.S. dollar that they back and issue?
That's to me, that's much more of a political decision than anything else, right? I mean, the U.S. Treasury would create it if they don't want the banks to have the power that they have, right? That's what stable coins do.
So we're basically gonna have a state-run I'm
not saying that at all, but that's what you're describing, right? If you take it to the extreme, why wouldn't the Federal Reserve just issue a digital dollar? Why do I need banks?
Well, you just
in
said
that case,
we have digital dollars and we need banks for a whole host of other reasons.
well, you need banks for the financial intermediation to create credit and all those things.
Right. Okay. So let's go back 4 years because there were some issues with stable coins, and they weren't backed one for one.
They weren't backed.
And how was that able? Like, why was that able to happen? And what's changed between now and then?
Well, let's start with the last part, which is what's changed. Everybody figured out that they don't work. They've never worked in 600 years of central banking. They've, kind of an algorithmic stablecoin. People have tried to stabilize their currencies for thousands of years, frankly, but it's the last 600 years for sure. They never work. They don't work.
But Tether wasn't a systematic sort of thing.
No. But Tether, I would not necessarily say that Tether failed. Right. It's backed by, from what we can tell, treasuries, and that type of thing. There was a period of time that it dropped slightly below $1, but only for a period of time. That's
why has the transparency changed between now and then? Because there were some that broke the buck, and there was kind of
because they were fractional banks, right? That's what they didn't have the reserves, and they now with the new Genius Act, with all the regulatory changes, you're going to have to show that you had the reserves. So that's a change.
Here's a question for you, BK. Fill in the blank. If blank happens, my view on cryptocurrency, my view on Bitcoin would change, not dramatically, but change.
If central banks suddenly decided, hey, we are no longer going to inflate away fiat currencies, that's not what we do. We're actually going to, make our currency stronger. That would you wouldn't need necessarily Bitcoin for that, right? That I would say that. It's probably the biggest one. I don't think it's going to happen. It hasn't happened in 600 years.
Nor do I. But... So here's my follow-up. And I remember when there was the first Trump administration, I had never seen this, and I'd looked back in history to sort of find out. But he openly talked about the U.S. dollar being too strong. And, he was right in terms of the problems we were facing. It was the first president I ever heard say the quiet part out loud. Now they're being, much more vocal about it. As a matter of fact, it was last week he flat out said that, as much as he's for a strong dollar is not helping in any way. And I think Treasury Secretary Bessent knows more than anybody that when you have a $38 trillion hole sitting on top of a $28 trillion economy, you're not going to grow your way out. You're going to devalue your currency way out, which I think lends itself to exactly what we're seeing here, which is why I asked the question in the first place. And your answer sort of backed me up.
Yeah, if the way that everybody in the world runs their central banks and runs their economy changes, then you don't need gold, you don't need Bitcoin, you don't need any of those things. The odds of that happening, I think, are pretty slim. I'm willing to bet against that.
All right, explain, and that all makes sense, and this is kind of going back to stable coins too. So let's say we're not going to have this treasury issued, stable coin, but like we've heard that Walmart's going to have a stable coin, PayPal's going to have a stable coin, all these like kind of quasi financial institutions, we're going to have like some of these that are just kind of meant to be the most popular ones. Like, that's right. Yeah. Why do we need all these different stable? Why can't there just be one stable coin? There's one US dollar and everything else is pegged against that.
Yeah. I would agree with that.
Okay,
we're not the ones making the decision. Walmart is, right? And Walmart wants it because they keep all the money. It's just like Walmart points or U.S. airline points or something like that. They keep the dollars. The dollars don't go out of their ecosystem.
And there'll be interoperability. Like that's the whole idea. Okay.
Sure, I would imagine they should be, but maybe not. Maybe Walmart wants to keep it, and just like PayPal and just like Zelle does, it's free. Yeah. But if they hold the dollars, then they can go and reinvest it and make the spread off the treasuries that they reinvest.
Isn't there risk to the reinvestment in the? Like, if you're going to have some bad actors,
Of course, all of that. Yes, all of that.
Okay, so the idea of investing in T-bills and taking that spread, okay, let's call it the net interest margin, right? And then the reason why someone would buy a stable coin because they want that return, why not just buy T-bills?
Yeah, that's exactly.
But you understand why my head is going around and around, and then I think, and I say to myself, if there's going to be hundreds or thousands of global stable coins that emerge, right? Yeah. Like that sort of thing, because they will, because if all those incentives increase for all of those.
And it'll be wildcat banking like we had in the 1850s.
Okay, but that's kind of my point. Isn't that setting up for the next freaking disaster financially around the globe?
Eventually. But that argues to me to buy more Bitcoin.
Guy?
Because ultimately Bitcoin becomes your ultimate stable coin. That's what Bitcoin is really supposed to be, is the ultimate stable coin. And over time, as more people use it and we get more players that are, hedging it because they're corporate players and all of that, the volatility will tamp down and Bitcoin will be the ultimate stable coin.
Yeah, it's sort of like we've seen before. All the the financial system, bankers get creative and they create all these products that work until they don't, and then just goes back to what they should have been doing all along. And I think in the crypto world, that's exactly what we're seeing now. You have the advent of Bitcoin, then all these creative people, are starting to sort of figure out how to make money and create processes or whatever the word you want to use around it until the inevitability happens and it goes right back to where it started, which is, to your point, BK, Bitcoin.
Right. And that is the history. That's human history. That's the history of financial markets. That's, we have it. Bitcoin doesn't solve that, right? Bitcoin doesn't solve fear and greed and stupidity. It just doesn't. But it offers you a way to opt out of all of that by holding some Bitcoin.
All right. So most individuals will not opt out of the fiat world. You know what I mean?
Right.
It's just not in there. Like it's kind of not in my brain because how I've been going back and forth. I'm happy for my money to be over at Citi or Chase.
That's why we're in the speculative phase now.
Okay, so what is the thing that changes mom and pop? You know what I mean? To say, is it just from an investment standpoint, or will they think about it as something? You know what I'm saying? Like,
yeah, I mean, typically the big changes like that, where mom and pop are like, oh, now I have to have it. Something cathartic happens, right? Something where they can't trust the banks. And I'm not saying this is going to happen. I'm just, you're asking like speculative, like what are the type of things that cause mom and pop to say, oh, I need to have all my money in Bitcoin. By the time that happens, Bitcoin will be stable. And a volatility junkie like me will be bored as stiff with Bitcoin.
Okay, so my question is, 16, 17 years ago, there were plenty of reasons, and this is where Bitcoin was born of, is the distrust, right, of just our, banking system in general, also our central banking system, that sort of thing. But don't you think that kind of, that the flip has, the switch has flipped a little bit where now to me, it feels like more of the risk might be in this decentralized financial system than the traditional banking system. Is that kind of fair? Do you see what I'm getting at a little bit? Because
yes. So I would agree that there is currently more risk in the decentralized financial system because it's new. It's not the banking system. It doesn't have the controls. It doesn't have the insurance. It doesn't have all of that. So yeah, of course, that's where the risk is, but that's also where the investment opportunity is because you have that risk. And I'm willing to take that. I would not suggest mom and pop go out onto a DeFi platform and start lending and borrowing and trading, crypto.
Guy has to leave early because he's going on a DeFi platform. Right?
Yeah,
Exactly.
He's
going to stop at the Blockbuster and then he's going to go.
I got to make sure I get to it before it leaves. So here's one of my final questions to you, BK, and I could do this for a while, as you know. To the extent that you even watch television these days, if you find yourself watching one of the business networks screaming at the TV, they're missing this. They should be talking about this. What is this?
Talk about being in each other's head, because I've been sitting here for the last 5 minutes going, we're missing the point here on all of this. Stable coins are not the point. They're fine. They're fantastic. There's going to be people that make tons of money. I get it. I get why Walmart wants to buy it. They want to make the spread. I get it. But here, and this, I have to credit Balaji for really kind of recently flipping my brain and turning it. It's finally, it's something that I thought about a long time ago, and I didn't think until Balaji pointed out a tweet that there was a catalyst with the stable coins. But stable coins with the Genius Act now give you a legal basis for a cryptocurrency to represent property. And so now everything can become property. Stocks can become property. Bonds can be. Stocks can be on.
Explain that, because if you own a stock, if you own Microsoft, we know people who've owned Microsoft for 40 years since the IPO. They've never sold it. They think of it as their property.
Absolutely, and it is.
So what's changed? So I don't understand what.
So prior to that, if I said to you, "Hey Dan, here's what I'm going to do. I'm going to buy Microsoft, and I'm going to issue a cryptocurrency, BK's Microsoft, and you'd buy it." Okay.
Why would I buy it?
You would buy it, maybe I convinced you, right? That's less important. You want to buy Microsoft, I give you some reason why you can buy it, right? But it's a cryptocurrency. Let's say I default on that, I run away with your money, that type of thing. There wasn't much of a legal recourse for you besides fraud, but there was nothing legally in the legal code of the US that said, hey, Dan actually owns Microsoft stock. All it said is Dan owns a cryptocurrency that Brian Kelly sent to it. But with the Stablecoin Genius Act, now it says, hey, Dan owns US dollars that are issued by Circle or Walmart or all of that. So it's that critical link back to the initial property that changes things. So now you can issue, instead of going out and issuing issuing stock like Microsoft does now, you can issue it on chain, which is a much more efficient way to create stocks and bonds, because the settlement of it is instantaneous. You don't need any operational help with it. It's instantaneous.
Yeah, but isn't that going to cause further innovation of the banking system that's been very stagnant, let's say, because that's part of the argument. But like, for instance, if, stock exchanges recognize the fact that they're going to get disintermediated by the idea of on-chain sort of stock issuance and the like, they're going to go from T minus this to T minus 0. I mean, like literally they're going to, but might they do it on blockchain too? But it's going to look a lot like, all right. But
but they might, right? But ultimately, in my view, and what's proven out over time, is the public, scalable, decentralized blockchains are the ones that win. It's just like in the internet, we used to have the intranet, and everybody's like, oh, it's a walled garden, it's all this stuff, blah, blah, blah. But it only works if it's interconnected with everything else. It's interchangeable.
Yeah. So, Guy, you just got on the line, right? And it took you a little bit to do that, to figure that out. His credit card is still not in any of these on the line sort of systems or anything like that.
Why would it be?
He's got a master charge still, I believe.
Master charge. He's got a
Diners
Club.
Club.
There's no doubt about it. Okay. All right.
Yes.
So, all right. My last question, and I really enjoyed this, and that, I read your book literally, 13 years ago or whatever. And it really kind of opened my eyes a little bit to this thing. And I hope you kind of update it, because I'm sure there's a lot you can do there. I just want to remind everybody, if you just kind of tuned into the radio show, if you want a copy of the Bitcoin Big Bang by Brian Kelly that was published in 2014, go to the Apple Podcast Store, leave a review for this podcast, take a screenshot of it, send it to contact@riskreversal.com, and we'll send you a book. Last question from me. And we can kind of tone it down a little bit, because you and I have been punching on this thing. It's fun. It's so much fun.
I really enjoy our chats.
It's fun.
Yeah.
But I mean this sincerely. I've learned so much about it. I wouldn't obviously be on my radar if it wasn't for you. Let's have some fun. Guy just said, if you are watching the financial TV and this and that or whatever, Guy and I have long said, like, one of the best things that has ever happened, he's nearly 20 years on CNBC. I've been doing it since 2009. Remember the options program?
I do remember that.
Yeah. And you were on the remember he was on the prop desk back then, Guy Adami? And so
I love that, by the way.
Guy has often said that he never got to know the new guys, because like when he was back in the shit in Vietnam, the new guys didn't make it that long, so you didn't want to get to know them a little bit. But we've always said the people that we met and who have made it, it's been so much fun. We have like great friendships, and you are clearly one of those guys. What do you miss about Fast Money? Like,
you guys,
really?
And I mean that. I mean that sincerely. I'm not just saying that because I'm on the radio program. I really do. I enjoyed doing Fast Money very much. I had a blast doing it. I enjoyed more making the friends that I did, and honestly, the conversations we had in the green room beforehand and in the commercials were some of the best conversations I've had. I mean, sometimes we just joked about nonsense, and sometimes we had like real serious conversations about the markets and whatnot. And that I miss a lot. That I miss an awful lot.
I miss you, and I will echo that. I loved it when I knew you were coming in the conversation, some of the just ridiculous conversations, which in and of themselves were fun. But I learned so much from you in terms of central banks and how currencies work and the bond. And I mean that sincerely. So a lot of the things I talk about now, I really gleaned from the conversations we had however many years ago it was now, BK.
Yeah, well, I feel the same way. I really do. I learned a lot about the gold market. I knew very little about options before meeting Dan. I used to use AOL Messenger. Some of you guys might remember that. And I would hit Dan on that. I'm thinking about this option trade. What do you think? And he'd be like, you're an idiot. Don't do that. Do it this way. And I would do it that way, and it would work better. So
yeah, well, that was kind of, aside from the fun that we had and the relationships that we were able to build over that period of time, I mean, I learned a lot. I mean, it's funny. I go back and I think about like when I started in the business in the late 90s, I couldn't, like, the macro stuff, you know what I mean? Like, was like oblivious. You ever go back and you think of your career as like, oh my God, if I just knew a fraction of what I know now back then, I might have been actually good at at what I did. All right, let's leave it there. Hopefully we'll get BK to come back on the podcast sometimes. We can't wait a couple years. I mean, we get to see each other every so often, and it's really great to reconnect here, BK. I feel like we never really left each other.
Yeah, I feel that way too. So, you're always right here, dude.
Yeah, like in your
always
heart.
right here,
Okay.
buddy.
Well, Guy
Oh yeah,
Adami,
they can't see me on the radio program, but I'm touching my heart.
Yeah. Thank you, brother. Thanks
All right,
for
thank
being
you
here.
guys.
Thanks.
It's been a blast.